Welcome to Sophie Daddy's channel. You know, the stock market's been on an absolute tear, hitting all-time highs. But while everyone's celebrating, a really important warning just came out from, well, the highest level of finance. So today, we're going to do a little investigating. We're going to decode that signal and figure out what on earth it means for all of us.
And this is it. This is the comment that got everyone's attention. Jerome Powell, the head of the Federal Reserve, used these very, very careful words. Now, when the guy in charge of the most powerful central bank in the world says something like this, it's not just a casual comment. It's basically a giant signal flare. You have to pay attention.
So that's our mission today, right? What exactly is the Fed looking at that made him say that? We're going to dig into the very same data, piece by piece, and try to answer the million-dollar question, how worried should we actually be?
All right, let's start our investigation. We're officially in the evidence-gathering phase. Think of us as financial detectives, trying to piece together all the clues that led to Powell's big statement.
Okay, our very first piece of evidence is just a number, 39.9. Now, I know that might not look like much, but trust me, in the world of market valuations, this number is a total showstopper. This is the current reading of something called the Shiller P/E ratio.
And here is where it gets really interesting. A number like 39.9 doesn't mean anything by itself. But when you compare it to its 150-year historical average of about 17, whoa, it's more than double. In fact, U.S. stocks have only been this expensive two other times in history, right before the massive crash of 1929 and at the absolute tippy top of the dot-com bubble. Yeah.
Okay, clue number 2 is another pretty startling number, 219%. This is what's known as the Buffett Indicator. It's a really big picture view, basically comparing the total value of the stock market to the size of the entire U.S. economy.
And again, it's all about the context. The stock market is currently valued at 219% of the whole economy, when its long-term average is just 85%. Warren Buffett himself, the guy it's named after, once said that when this thing gets near 200%, investors are playing with fire. Well, we're not just playing with it, we're way past that point.
So what's really crucial to see here is that all the signals are saying the same thing. It's not just one warning light blinking on the dashboard, it feels like the whole dashboard is lit up in red. From the Shiller TE to the Buffett Indicator and others, they all point to one conclusion. The market looks strongly overvalued.
And this might be the nail in the coffin. For over a decade, you heard investors talk about TINA. It stood for There Is No Alternative to Stocks, because bonds paid you practically nothing. Well, this chart right here shows that TINA is officially dead. You can now get a guaranteed 4.2% from a super safe 10-year government bond, but you only get a tiny 1.2% dividend yield from the S&P 500. For the first time in a very long time, stocks have some serious competition.
Okay, so we've gathered all the evidence. The next logical question is, have we ever been in this spot before? It's time to pull out the old case files from history and see what happened the last time market valuations got this extreme.
And the historical record is, well, it's crystal clear. This table shows the two other times valuations got this high. If you put your money in at the peak in 1929, 10 years later, your real return was negative. If you invested at the peak of the dot-com bubble, 10 years later, your return was also negative. It's what people call a lost decade. High starting points have historically meant a decade of going nowhere.
So our investigation leads us to a pretty unavoidable verdict. The evidence completely backs up what Jerome Powell was hinting at. The market is in what he calls rarefied territory. And history tells us pretty consistently that this is not the setup you want for high returns over the next few years.
Okay, so that's the diagnosis. A little scary, right? But what's the prescription? We all know that trying to time the market, getting in and out at the perfect moment, is a fool's game. So what's the smart, disciplined thing for an investor to do when they're staring at all this evidence?
So what is the plan? This is not about hitting the panic button and selling everything. Not at all. It's about having a smart, actionable playbook to help you navigate what could be a tricky environment. So here's a 5-step strategy, and it's all based on time-tested principles.
Here's the game plan at a high level. We're going to reinforce our defenses with something called asset allocation. We're going to get way more picky about our stocks by focusing on value and quality. We're going to beef up our defensive sectors, look for opportunities outside the U.S., and use a systematic approach to investing. Think of it like a multi-layered defense for your portfolio.
First things first, your asset allocation is your #1 line of defense. With interest rates over 4%, high-quality bonds aren't just for safety anymore. They give you real income and act as a critical buffer if the stock market gets volatile. The key here is to rebalance every so often. That just means trimming some of the profits from your stocks that have done really well and moving that money over to bonds.
Next up, inside your stock portfolio, it's time to be a smart shopper. You want to focus on value stocks, good companies that are trading at a discount. That gives you a margin of safety. You also want to prioritize quality companies with really strong financials and not a lot of debt. And it might be a good idea to lean into defensive sectors, companies that sell things people need no matter what, like food, electricity, and healthcare.
And finally, we've got to think globally and act systematically. You see, this extreme overvaluation we're talking about, it's mostly a US story. A lot of international markets are actually much more reasonably priced. And if you're still adding money to your investments, use dollar cost averaging. Not just means investing a fixed amount on a regular schedule. It takes all the emotion out of it and actually lets you buy more shares when prices are lower. It's a win-win.
So after looking at all the clues, checking the history books, and laying out a strategy, what is the one big takeaway from our investigation today?
It really comes down to this. The data is clear. The US stock market is, by historical standards, very expensive. But hearing that reality shouldn't make you panic. It should make you disciplined. It means it's time to shift from a strategy of just hoping for the best to one of active, smart risk management.
And that really just leaves us with one final question to think about. When we're watching a market that so often gets driven by hype and emotion, the biggest challenge for every single one of us is to stay rational. The data and the history are pretty clear. The real question is, will you be the investor who actually listens? Thanks for watching.
All right, the learning doesn't have to stop here. If you want to explore even more, I've built the perfect place for you at sophie-ai-finance.com to unlock a new way of learning. Think of it as your personal learning toolkit. If you just want the big picture, you can watch the video or listen to the podcast. It's perfect for getting the main concepts down while you're on the go. But if sometimes you need to hit the pause button and really let an idea sink in, you can visit the blog article. It has all the details, charts, and text from our discussion so you can review everything at your own pace. And for those of you who want to see all the math, data, and the complete nitty-gritty behind the analysis, well, I've got a full research paper waiting for you, so you can really dig into the details and see how everything works under the hood. It's all there, all for you. And hey, if you have any ideas for new topics about finance and AI you'd like me to cover, please leave me a message. Thanks for tuning in, and I'll see you in the next video.